Hi, this is Richard Campo from Rose Capital Partners. I wanted to put this video together for you to give you some of the key considerations if you're looking at moving home from a mortgage perspective. There's probably been quite a bit of change in the mortgage, especially if you haven't moved for a while. Probably the key dividing line is if you moved before or after 2008. If you moved after 2008, mortgages are pretty much the same as they are today. Pre-2008 was very different. Banks took what was called a risk-based approach typically. So if you had a very large deposit, very few questions were asked and they may not even assessed your income. So as we learned in 2007, 2008, that wasn't a great idea, didn't shake out too well. So there's been a big move to what's called affordability lending. Now that's starting with your income, seeing how much you can afford and working backwards. That's far better because it makes the market more robust and actually it makes getting high loan to value mortgages much easier. So if you've got say a 5, 10, 15% deposit, it's easier to get a mortgage now than it was pre-crash. So that's actually a real positive thing. The rest of it is broadly the same. So when you're looking at moving, you're probably two key considerations there are going to be how much going to borrow and how much is it going to cost. So how much going to borrow? Again, there's a sort of simple answer to this, which is about 4.5 times your income, there or thereabouts. Some banks go up to a maximum of 5.5 times income, but then the biggest consideration is what's deemed as income. So if you're employed or self-employed, that's two different camps again. So let's start with the employed stuff. Let's pick a really simple example. Let's say your income is £100,000, so you think, well, I can borrow 450, fairly simple stuff. But then if you assess your income and actually you have a £50,000 basic and a £50,000 bonus, what some banks will do is take either half of that variable income or sometimes none at all as well. So it's really important you talk to the right lender. But what the market average is taking about half of that variable income. So let's do the maths again. So banks will actually assess you at 75,000, not 100. And then times that by 4.5, that takes you to, I think, 337,500. So quite different there. And again, very, very simple example. Some banks will take all of it, some will go further still, but that's just a good sort of finger in the air as to where you can get to. Now, if you're self-employed, it's a lot more complex. What banks do is take one sum or all of the following, which would be things like your salary, dividends, your profit, or what's sometimes called your profit on ordinary activities before tax. You might even be an LLP partner and just take drawings as well. So there's a number of things going on there. But once you get down to the point of a bank assesses your income, what they'll look at your tax returns or however that's structured and say, yeah, we'll give you sort of 4.5 times your income. So again, same sort of basic measure, but the assessment is very different. And that's why it's just absolutely essential to talk to a professional. Things like any outgoings will be taken off as well. So if you've got like car loans, childcare costs, that sort of stuff, that is deducted and then that multiple applied. So I don't want to overcomplicate it now, but just be aware that any outgoings that are going to continue past the mortgage will be factored in also. So that's roughly how much you can borrow. In the next aspect of how much will it cost, again, that's largely down to the structure of the loan, which again falls into two broad categories. The first part is what we call the repayment vehicle, so how are you going to pay the loan back? There's sort of three ways you can do that. Firstly, it's called a repayment loan, or there's interest only, or there's part and part, which is a combination of the two. With repayment, nice and straightforward. So you make your monthly payments, and at the end of 20, 25, 30 years, whatever, the mortgage loan's paid off. Interest only, you just pay the interest that sits on top of the account, and at the end of the term you look to pay that off by bonuses, selling the property or other investments, that type of thing. So a bit more risk there, but much lower on a monthly basis. So that has the biggest driver on monthly costs, whether it's interest only or repayment or a combination of the two. Next to that then will be what type of product you go for, and again these fall into two broad camps. You've got fixed rates, which does what it says on the tin, typically a 2, 3, 5 or 10-year product. You fix your payments and you're set for that period of time. You also have got variable rates, which are sometimes cheaper but sometimes more flexible. These can go up or down in line with the market, but because it gives you that greater level of flexibility by often having penalty-free options, that might be better if you're looking at moving, you have large amounts of cash coming in, that type of thing as well. So it's not just about the headline rate, it's about looking what sort of features you want. So they're really sort of the key considerations that you need to think about. Again, it's a bit of a complex area, so if you'd like to talk to me or any of the team, please do get in contact and we'd love to help.